Yeah, look, historically, you'd have to say the market is looking interesting given where it is. So it's at the same level as 9 years ago. On a valuation metric, it's fallen into value. There's no doubt about it. The Australian market, using a bond yield of 3%, is presenting today as good value. However, the outlook is difficult. You know, as I said, the risk of recession is there on the table. It's not odds on, but it's certainly a risk which we have to acknowledge. Is the bond yield sustainable at 3% in Australia? Look, given the world situation where the manipulation of international bond markets is occurring, arguably yes, and arguably our bond yields are higher than a lot of countries who have incredibly bad credit ratings. So in that context, but in a more historical context, bond yields are too low. So the risk-free rate of return is too low. So your proxy for assessing value is skewiff, you know, and that's the problem. You know, I talk to people about the market. When the market's going up, they reckon it's great value. When it's falling, it's not good value. You know, the market was good value 10% higher. Now it's bad value when it's 10% lower. It's in the eye of the beholder, and there's a lot of sentiment issues around it. Anyone who owns equities and is not prepared to take a 20% drawdown should not be in the equity market. And I think we've got a lot of people, self-directed, latecomers to equity markets, driven by the requirement to look after yourself in retirement, who have never been educated about the equity class as a high-risk asset. You have to expect up to 20% drawdowns. Now, admittedly, they're coming a lot quicker than historically, but that's the rule of thumb. You have to be aware that your capital can decline fairly quickly. And you might not be compensated for a period of time by income, because those declines may be a forerunner to a recession, or they may be a forerunner to some financial crisis. So the answer to your question is the market today is looking interesting. Again, there is absolutely no hurry, because the world is in a state of flux. You know, we are sitting here waiting for the end of monetary stimulation to occur. We're a long way away from that in Europe. The Japanese situation is, to my eyes, out of control. Growth there is negligible for the massive amount of stimulation. And the American central bank is so confident about the future, it doesn't even want to talk about putting up interest rates by 0.25%. I mean, the environment tells you it's a difficult period. Now, you can speculate your head off, or you can invest. Today in Australia, at these prices, is not a bad time to invest. Slowly, deliberately, but have a look at long-term returns. And if the market fell another 5 or 10% from here, be prepared to wear it and have enough cash to access it. Okay, the end of the world is not nigh. Australia will grow, for as far as I can see. We are struggling under management of the economy, and of the I think even business management is stressed at present. But we will get through this, and I'm expecting the circuit breaker to be the currency. If the currency falls, then the Australian market is fairly cheap.